Volatility is not up, it's down. Yields aren't up, they're down. Inflation expectations are down. So I hear this, that as if people don't understand. I think they actually understand quite well.
Joining us now is Shana Sissel, Banríon Capital Management founder and CEO. Shana, great to see you this morning. And I just want to pick up on those comments from Chair Warsh, this idea that he doesn't need to issue forward guidance, or at least it's not a problem for this market because we have seen volatility come in. Things have been relatively benign. Do you think that this is a market that will green light a Fed and behave accordingly if we're not getting any sort of forward guidance in this new environment?
I think it will be. I actually think it's a welcome change. As he noted, one of the things that has kind of dissipated from the markets has been volatility. Markets have been very low vol for a very long time, largely because of forward guidance given by the Fed. As he commented, the markets are reacting to how they think the Fed will react. And when the Fed is very transparent like that, they are not necessarily reacting to the data itself, but rather how they think the Fed will react to the data. That's not naturally something that's part of the Fed's policy, and the Fed is not responsible for ensuring that markets stay low volatility. So I've been of the belief that we should position ourselves for rising volatility throughout 2026 and into 2027. And having Chairman Warsh say what he said just reiterates how I already felt, and I think that market participants will act accordingly and adjust accordingly.
How do you position for that, Shana? What are the adjustments to make to account for rising volatility?
Well, now that's speaking my language. I'm the queen of alts, as they call me, and so alternatives are one of the best ways to mitigate volatility. It's not always the sexiest way. It's not going to, as many people might think, increase your absolute returns, but it can very well maintain strong absolute return performance while reducing overall volatility in portfolios. And when I say alternatives, I mean the diversifying kind. Most people start to associate private equity, private credit as the main ways to access alternatives. That's not what I'm talking about. I'm talking about managed futures. I'm talking about long-short equity. I'm talking about market neutral. I'm talking about commodities and anything related to trend following. Those are the types of things that tend to help mitigate volatility when put into a diversified portfolio as, say, a 10 or 20% slug. And these are things that everybody can now access through ETFs, interval funds, and otherwise. This is not something that is previously it was gate-kept to only those who had sufficient wealth to meet the accredited investor hurdle, but that's no longer the case. You can now access these types of products through ETFs and through interval funds.
I just wonder if we are heading to an environment where the outcome of this central bank is hikes, and it's something that the market has started to price in the likelihood of, certainly not 100% pricing anymore. How will risk assets behave, Shana, considering more volatility, that equity markets just came off the back of a banner quarter, the best since 2020, and for semiconductors, the best ever? Is this a market that's prepared for rate hikes? Can we absorb that?
Well, I don't think rate hikes are happening tomorrow. So I do think that the markets can absorb that because they have plenty of notice that these are likely to happen. But let's think about it at its core. What do rate hikes mean? It means that the economy is very strong. It means that inflation is rising, and it's an attempt to keep things in check. That's not a bad thing if you're a market participant. You certainly don't want things to get overheated. You certainly want valuations to be reflective of the value of these companies and not to get too out of hand. And that's what would cause rate hikes. Now, that said, I don't think rate hikes are coming this year. If they do, it'll be later this year. So we do have time to make adjustments. And if you look back historically, rate hikes aren't always a negative for risk assets. In fact, sometimes they can be positive. There's no true correlation. I did a project when I was at Fidelity on this regarding small caps specifically. And what we found was that it wasn't necessarily correlation, that rate hikes didn't always mean that small caps would underperform. And I think we can take the next step and say that that doesn't always mean risk assets will underperform. But I do think you need to position yourself a little more defensively and for rising volatility. And that's where I think alternatives can be valuable and helping mitigate that risk if you're unsure of how risk assets will be. But you still want to take that risk. You want to offset it with something that will decrease the overall volatility of your portfolio.
Hey, Shana, really fantastic to catch up with you this morning. Shana Sissel of Banríon Capital Management, thank you so much.